The S&P had a good week last week, with performance mainly driven by consumer discretionary and the technology sectors. Real estate is following in their tracks. Strong performance in the bond markets was definitely a good push in the back for this move. Another asset class that had a good week was the crypto market, where Bitcoin rallied strongly and is now pushing against overhead resistance near 21,000 US dollars. Hello sector watchers, welcome to the show. This is the 159th episode of Sector Spotlight for Tuesday the 17th of January, and I'm recording it on Martin Luther King Day, Monday the 16th. So I hope you all had a very good long weekend and are now ready for a new week in the markets. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. This episode of Sector Spotlight is all about the sector rotation model and trying to gauge where we currently are in the cycle based on current sector rotation and the readings of the macroeconomic indicators that are an integral part of the model. Ladies and gentlemen, this is Sector Spotlight. It's time to start taking a look at the sector rotation model again. It's been a while since we did that, and I'm trying to do that every quarter. So where can you find the theory of the sector rotation model? You can find that below what we call the perf chart. So if you go to the perf chart, that's this chart here, which shows you the historical performance of all the sectors or any group of tickers that you put in there, and you scroll down, then you will find the sector rotation model or the sector rotation model framework below it with the sine waves that it's trying to track and the macroeconomic indicators. Please don't forget this part below because it's an integral part of that sector rotation model. Now, for this occasion, I want to switch to the equal weight sectors because obviously the sector rotation model is addressing the broader economy, and the S&P 500 and the sectors, the spider sector ETFs that we usually use to track the market are cap weighted, as you know, and they are heavily influenced by a number of mega cap stocks, and right now it's actually quite actual that there are a few stocks where a few single stocks have a big impact on the performance of a single sector, and to not going to say eliminate, but mitigate that big effect to some degree, you can switch to the equal weight sectors, which will give you a more modest and broader sense of the rotation that is going on. So on the right hand side we have the RRG of those equal weight sectors, and that is actually a drop down in the groups box, so you don't have to type those symbols yourself. There is a group that holds all these equal weight ETFs. And I want to go over the rotations and then address the individual charts with the RRG lines and the relative strength to make an assessment of where all these sectors are inside the sector rotation model. So I'm gonna color code the sector names across the top of that cycle image. Now let's start with the RRG itself, and I'm just gonna we'll fill this in later when we do all the individual charts, but let's go over all these tails here and have a quick look at them one by one. So we start at industrials, and as you can see, it's inside the leading quadrant, but it's rolling over, so it's losing some of its strength that it had over the last few weeks. If you look at materials, that's actually pretty strong. It entered the leading quadrant and is still moving to the right, and it's got the highest RS momentum value in this universe. And this is one of the sectors, if you look at the RRG for the spiders, then you will see that the materials, and especially the discretionary and staples, have quite a big difference in the tails on those two RRGs. So here you got consumer discretionary, and that's actually inside leading, and it just curled back up with a very sharp hook. It's very unusual to see that sort of counterclockwise move, but you know that when we switch that to a daily or to a shorter term time frame, you will see a very rapid rotation, which is actually in a clockwise fashion. It's just too fast to be picked up by that weekly tail. If you would plot the XLY tail on the normal RRG, as you know, it's inside the lagging quadrants, pretty much on the opposite side of what we see here. So, and obviously XLY is heavily influenced by the performance of Amazon and Tesla, and you can see how big that difference is if you monitor the position of the RCD trail and the XLY tail on the SPY RRG. Basically the message here that under the hood, the consumer discretionary sector isn't doing all that bad. We go to the next one, that's healthcare. Again, it's also inside the leading quadrant, but it's rolling over. It's losing some of its recent strength. And the next one is real estate. As you can see, it's a very nice move powering into the improving quadrant, still far to the left, which means that the relative trend is still down. But there is certainly something going on under the hood that's good. And that is pushing that tail up into the improving quadrant. I wrote a blog article last Friday, was in the newsletter, on the return of the REITs, and it's actually addressing the improvement that's going on in that real estate sector at the moment. The second one here is communication services. As you can see, a nice sharp hook. It was in lagging and it's now pushing into improving. Again, still very far to the left-hand side, so still in a relative downtrend, but there is improvement starting to be visible, starting to get visible. If you look at utilities, that has had a very strong move over the last few weeks, just pushing into improving. The only thing that's not that nice is that that last segment here is kind of bending to the left again, so it's not following through with that nice strong move into improving and picking up a better angle, a better RRG heading. So it's good, but it could have been better if we had that angle which is pointing to the right. Maybe next week or the week after. So here we've got energy, obviously the sector that has carried a lot of the performance over the last few weeks, maybe even months. And you can see that it is still the highest reading on the RS ratio scale, but it's rapidly losing relative momentum. So what we need to wait and see is whether this is the end of the performance of the energy sector or just a dip, a temporary dip, and it will curl back up and return back to the leading quadrant after that dip has gone. There is plenty of room on the RS ratio scale for that to happen, so don't abandon the energy sector yet, I would say. Financials had a good run. They are inside weakening, coming very close to crossing over to lagging. But and I need to blow it up a little bit. You can see that the last few segments are shortening and the tail is flattening. So there is, the odds are there that we're still gonna see that curl back up towards leading and keep the financial sector on the improving side of things. Bit too early yet, but keep an eye on that one. And then you got technology, which is still inside lagging, but you can see the improvement, and especially last week's segment was pretty strong move, almost crossing over into improving. So there is improvement for the technology sector. Finally, I was going to say. And then the last one here is consumer staples, and that is also one that's quite divergent from the spider, the regular RRG. As you can see, that staples here are moving into the lagging quadrant, actually starting a new downtrend. And if you if you still remember what happened with discretionary, I'm going to put the two together. So you got staples moving at a negative heading into the lagging quadrant, and we've got consumer discretionary already inside leading and picking up a better angle, a better RRG heading again. So that is, if you watch consumer discretionary versus consumer staples as sort of a risk on, risk off indicator, that is now definitely starting to shift back to a risk on signal again. So with that rotational image, that rotational picture now on our radar, I'm going to go once again over all these sectors. And again, we're still in the equal weight phase, in the equal weight section. And I'm going to use the sequence that's across the top of that sector rotation model. And we're going to add a color to all of these individual sectors. So starting with technology. And as you can see, the first higher low is in place. We're moving our way up. That trend is still down. You can see that that move here is kind of stalling. And you can see how the RS momentum line has already started to pick up and RS ratio is flattening out. So I'm going to color this like bluish, which means that it is still negative, but picking up a little bit. So maybe, you know, call it the coloring of the quadrants if you wish. The next one is consumer discretionary. And look at the strength of the relative strength line and the RRG lines, obviously, but also that breakout in terms of price. This is starting a new uptrend, which is completely the opposite thing of what we've been seeing in XLY. And that's, I think that is you got to keep that in mind. Consumer discretionary obviously is a very important sector, but it is dominated by two major mega cap stocks. And under the hood, the sector is actually doing much better than one would like to see on the surface. So consumer discretionary, I'm going to rank that as a plus, as a green. That is a sector that's actually doing really good, or expected to do really good. The next one is communication services. Here also, you can see that there is a nice breakout on the price charts, breaking out of something like a double bottom, and that downtrend has now ended. The only thing that's not super strong yet is the relative strength. You can see that this series of lower highs and lower lows is still intact. The last two lows were at the same level, which is a good thing, and you can see the improvement picking up, but it's definitely not turned around yet. Hence, we're going to let that as a bluish color, so it's improving. It's ready to improve, ready to get there, but it isn't there yet. Next one is industrials, and that is very clearly a plus. We've got that. There's a little hiccup here, a little rollover in momentum after a nice rally, but you can see how that is caused by that flattening of the RS line here. This is breaking above its previous high, so I'm going to judge this as some sort of a pause, especially when I combine that with the nice break that we can see here on the price chart. So I'm going to expect that the trigger, the plus that we're going to get from the industrial sector in terms of price, was going to start to drag up that relative strength line in the coming weeks. So I'm going to call it that as a green. That's a positive sector. Next one is materials. Also here, inside leading, slight loss of momentum, but still very nice, turning around in around strength line. But here also a nice break. You could call this an inverted head and shoulders pattern. It's some sort of a reversal, looks like a head and shoulders, which means that there is quite a bit of upside potential for the materials sector, making it a very strong sector from a relative perspective and a price perspective. So definitely a green for the materials sector. And then we've got energy, and obviously energy has been driving the market higher over the last few years maybe. Look at this, look at when it started. But the last rally didn't make it, right? Resistance just below $80 for our RYE. We're pushing up right now, but we do need to see a push above 80 for this to continue. But right now, that relative strength line is running into some damage. You can see the RRG lines rolling over. So the energy sector is still good, but it's rolling over, it's losing momentum, hence the orange coloring. And now we've got consumer staples, as I said, one of the weaker sectors, and you can see why. It's moving into the lagging quadrant, and that RS line has bumped into resistance and is now coming down again, especially when we can take out these lows that will very likely cause an acceleration and push those RRG lines lower, confirming the weak reading for the consumer staples sector at the moment. And you can see that here, that overhead resistance area between 175 and 177.5 is getting stronger and stronger. And with this type of relative strength, it's very unlikely that we're going to see that breaking higher. We go to healthcare, then that is definitely breaking out of that, again, bottom type-ish pattern. Series of lower highs, lower lows is broken in favor of higher highs, higher lows. Old resistance became support a couple of weeks ago, and we're now again pushing, let's say that 300 level in RYH is our next confirmation when we take that out. In terms of relative strength, it's got a lot more trouble. So I'm going to keep that at a positive, but weakening, but rolling over. That can change if we can take out that resistance around strength combined with that break in price. It could be, but if you look at how this thing is shaping up, I wouldn't be surprised if healthcare in terms of relative strength would remain much more sideways or even start to roll over and become an underperformer. Then we've got utilities, and here also you can see that weakness in relative strength that is rolling over here. We have the sort of sideways movement in terms of price, a lower high in place and very close to breaking that former low. I'm gonna call it this red, because I think it is ready to roll over, and we didn't make it all the way up. So utilities is definitely one of the weaker, starting to be one of the weaker sectors, even despite that rapid rise in relative momentum. It already starts to lose momentum, and you can see why that is. So that makes the utility sector pretty vulnerable. And then the last two, we've got financials here. You can see how that has started to improve. We are now going through some sort of relative weakness, but on the price chart, you can see that we're pushing against that overhead resistance around $60. And we've got a first higher low in place. So this is definitely shaping up for the better, definitely turning around for the better. And a confirmation will be when you see RYF pushing, let's say, above $60 US. That will be a really good sign, and that's very likely going to improve the relative strength for that sector as well. And then finally, we've got the real estate sector, again, which I wrote the blog about. That under the hood, the improvement here is definitely visible. You can see how our momentum has pushed above 100. That drop in relative strength is losing momentum, is leveling off right now. So we've got to wait until this is starting to turn around, and very likely a trigger will be when EWRE will take out $33 to the upside. Right now I still have it as a blue, it's negative, but it is improving. The next thing that we need to take care of in terms of the sector rotation model is go over the macroeconomic indicators, how they are reading. And as you know, these macroeconomic indicators, they are stored in my public chart list, and the link to that chart list is in the description of the video. So the first one here is consumer expectations, the consumer sentiment index. And I think that is reviving. I'm labeling that as reviving because we had that sharp, super sharp decline here, and we're now pushing back up. So we had that early recession phase, it's now reviving. So according to sentiment, we're in full recession, we're reviving. Coloring that here, our bordering that reviving block. The second one here is industrial production. Now, how to read that? I think it's either rising or flat. It's probably more rising than flat, but somewhere in that neighborhood. So I'm going to label it as rising because I think we're still more rising than flat. But it can be either or. That's for industrial production. And then the next one here is interest rates. And although we're seeing some sort of a decline, I'm still saying that this is a rapidly rising interest rate for that 5-year Treasury yield. Coming from around 0, and now we tipped to 4, a little bit over 4, and now we're coming just back. So I'm going to call this rising rapidly, which means that we're in the phase of full recovery when you take the Treasury yield macroeconomic indicator. And then the last one is the yield curve. Well, there's no doubt about that. That is still inverted. Seriously inverted, I've got to say. You can see, going back here, you've got to go back to the early 80s to see the yield curve being inverted as strongly as it currently is. And also for quite a while. That's also something that is quite interesting to see. So early recession here. Now, if we sum all of that up, then you can see that it's I don't know, mind-boggling, maybe no, but it's quite surprising that all 4 of these macroeconomic indicators are pointing to a different phase in the economy. So what to do with that? I haven't seen this type of constellation, this type of reading very often. So I'm going to say that the sector rotation model is confused. And you can see, if we go to the sectors across the top, you can see that it is somewhat similar. There is not a very clear, the strongest concentration is probably here in the full recession area, where discretionary industrials and materials are doing really well, and technology and communication services are starting to come in, and real estate and financials as well. So I'm gonna point the sector rotation. It's going to be very, very broad. It's not going to be a very pinpointed phase that we can see, but I'm inclined to make this reading that we are going from an early recession into a full recession. Now, I'm not a full-fledged economic strategist, but if I just, in the back of my mind, read the newspapers and follow the news, I think that's something that everybody agrees upon, that we're kind of in a recession right now. And that means that the market is moving from a bear market into a market bottom. Now be careful, a market bottom is not necessarily a new bull market yet. The market is trying to find a bottom, which is kind of aligns with everything here, that it is confusing, but we are in that phase where the market is trying to find a new equilibrium, trying to find a bottom, and in the very early stages of that phase, these are the sectors that are tending to do well, and we are already seeing discretionary industrials and materials picking up. Technology, communication services are coming, and so are real estate and financial. So we're either late stage early recession or early stage full recession, which means that we're smack in the middle between a bear market and a market bottom. And the only way to find out what it is to monitor the market, which we will be doing. But also I think that what we'll see now is that there is a lot of sector rotation going on. It's not like, hey, all these defensive sectors are now outperforming, or all these offensive sectors are now outperforming. It will probably be very much more dispersed, needing a lot more of our attention. Wrapping things up, I want to draw your attention to 2 charts actually. First one is SPY, and I think we all know this chart, and that falling trend line is still there. Lower highs are still in place. We got a higher low So the downtrend theoretically has ended, but we're not in an uptrend yet. What needs to happen is we need to take out that falling resistance line and preferably break above that 408, 409 previous high. That will ignite a new series of higher highs and higher lows. I think that the positive divergence in the RSI is gone because we've pushed above 50 a few times. However, the positive divergence in the MACD is still very much present, and that could help us in the weeks ahead to push out of that, above that falling resistance line. But a more interesting chart probably is the one of RSP. We've been looking at equal weight sectors all of this episode. RSP is the equal weight version of the S&P 500, is the equal weight ETF. And you can see that the image of that chart is quite different than what we saw with SPY. And we are actually at the same, so we're in a trading range and we're pushing against the upper boundary of that trading range. When that happens, that is undoubtedly a very strong signal. But look at the relative strength. This is the relative strength between RSP and SPY, so between equal weight and cap weighted version of the S&P 500. And there's no doubt that the equal weight version right now is to be preferred over the cap weighted version. So the short message is that you can buy SPY, but eliminate the mega cap names. So SPY is actually doing pretty good, or starting to do pretty good. Just forget about the mega cap names and stick with the equal weight version for the time being. So I think for right now, an outperformance of the equal weight version over SPY looks to be in the cards in the next couple of weeks. And that wraps up the show for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. And of course, you can catch the replays on YouTube or any of the on-demand channels. Looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.